Hello, everyone. I'm Ravi Handa, host of Desi Fire podcast. This is a channel on which we talk about financial independence, early retirement, and I like to share some of my personal experiences of how I am going through an early retirement phase. If this is an area that you are interested in, then I would suggest that you subscribe to this channel and probably you like what you'll find here. And in this series of talks and chats that I have been having, today we have Kartik with us, who runs Financial Fitness. It is financial advisory sort of a thing. So, a lot of times you have a question that, okay, who should I go to? Who should I take advice from? Kartik is the sort of guy who has helped me a few times whenever I have had doubts about what to do and what not to do. So when I was planning to make this episode, I reached out to him and he said that, yeah, sure, he'll be willing to talk about it on camera as well. So that's the premise. Kartik, welcome to the show.
Thanks for having me today.
So we'll jump right into it. Kartik, in your opinion, how much money do you need to retire early in India? What would be that number?
I think a number, 8 crores is a good number to target. You may, it's obviously, this is a very personal decision when someone chooses to retire early. But, an 8 crore number is something you can target and start with. I would assume you know why you're retiring because there's a lot more to it rather than just the number. But yeah, let's go with 8 crores to start with.
Yeah, to be really honest, man, this, $1 million retirement has been more or less there as a concept, as an assumption for early retirement as a number. But there is a lot of nuance which is attached to it because my number and your number and Amit's number is going to be different and dependent on a host of factors. So in this scenario, this hypothetical person for whom you are suggesting 8 crores, how old is this person?
That's a fair question. See, I think I'm assuming somebody gets into a FIRE frame of mind in their late 20s, early 30s. It's unlikely that somebody starts thinking about FIRE on the first day of their job. So this is not really an 8 crore number aimed at...
If that happens, that's a much bigger
that's a big
problem.
worry. But, 8-10 years into your career, you start having some idea about what you could do, outside your corporate job or, whatever you do, not just corporate. So I would assume, 20 or 30-year-old person, trying to live with a lakh and a half of expenses a month, should be able to FIRE at the age of 45, with an 8 crore odd corpus.
Mid 40s, early 40s is essentially the idea. Fair, I think. And what about dependents? Like, have you thought of, say, there are people who have 3 kids these days. So if there are 3 kids and 3 kids education or something like that, have you taken any assumption on what does this person's family look like? Is he married?
No, so I'm assuming an 8 crore number would work for you and your spouse, because that's it. Because if you're going to then add in further, goals that you would like to accomplish, then obviously the number keeps going higher. So it's not, going to include school fees, as in, higher education. It is a lakh and a half of an expense. So if you're sending your kid to something that costs 10,000-15,000 rupees a month, FIRE will take care. But if you're thinking that you can FIRE at 45 and send your kids abroad at 1.5 crore, then you have a little bit of a challenge.
Fair. So basically you're saying that the FIRE corpus is one thing. Any other big goals that you have that, let's say, I want to build a hospital in a village or something like that. People have these sort of goals. One of my friends' father is actually doing this in his retirement of sorts, that he's building a school, building a hospital in a place. So that sort of a thing. Or let's say your kids' education, you want to send them to NYU for film studies. That's the fanciest thing that I know. I don't know if there is
Right.
something fancier than NYU film studies. So all that is not considered. Fair enough. So it's just the husband and the
It's looking at yourself and to an
hmm,
extent your spouse and trying to live a lifestyle which is supported at a lakh and a half of today's expenses.
today's
So
expenses.
again, I would only add that a lot of these long-term goals tend to
Hmm,
be a little dynamic in nature. You may not have an expensive hobby today like playing golf, but maybe
hmm,
you pick it up at 40. So
ah,
I would say, it doesn't cover everything, but we all have to make a start somewhere, and hence, an
ball.
8 crore number to target in your early 30s, late
Hmm.
20s is very realistic and achievable. It's and we'll talk
Yeah,
about it as we go on, but it definitely doesn't cover NYU Stern or buying three BMWs in your garage at 45.
fair, fair. So, so someone who probably spends a lakh and a half a
Yes.
month is this sort of a personality that we are talking about. And, so when we talk about this now, let's say if I'm talking about this 8 crore as a number, how do I figure out that where do I keep this 8 crores? I cannot put that in a sofa. So I will need a place to live. Uh, I will need money every month to eat.
Yeah.
I will like to take vacations maybe once or twice a year, and I need to pay those bills. How do I take care of that? I have the money, but I don't know how to take care of all of these needs. So how do I do that? Do I buy a house of 4 crores in this, or do I buy a house of 50 lakhs in this? Where do I live? How do I plan my finances? I have made the money. I have the money right now lying in my savings account, and I have no other, and I have nothing else. What do I do? How do I go forward from here?
So, interesting question in terms of how you want to deploy the 8, assuming you have 8 crores and you're 45 years old today. You clearly don't need all of that money right away. So, a large chunk of it, nearly 75% of it, on let's say 6 crores, can actually
Hmm,
be invested for longer term future needs, right? So, we could look at equity investing. Again, some portion of it could go into startup investing or anything which is
hmm,
technically high risk, high return. The remaining 25% is what you'd want to keep in some form of ready cash. Obviously, not cash in the house, but a mixture of bank fixed deposits, safe for at least 2 years of expense. I would say keep it in the bank so you're not stressing about where is my money, will I be able to actually retire? Because, trust me, the equity market performance in a 6 month period is so volatile that you're going to get worried that, have you made the right decision and not really enjoy fire. So I would say, 25%, so roughly a crore, 2 crores, park in a bank FD, conservative funds, balanced funds. There's a whole range out there, but, to keep it simple, use a mixture of FDs and conservative funds. The remaining 6 crores, you assume you don't need it because 2 crores is what you can blow up in the first 4 years of fire. It includes your holidays. It will include extra lunches and dinners because you have more time going meeting friends. Because you have time and I know where you're coming from. You're always ready to meet someone at 3:30 for a coffee. Because there's nothing else in the day to keep you tied up. But I'm saying 2 crores is enough to do it. Keep the rest 6 invested, and I would also add every year reassess where you are headed, and just need to make minor tweaks. But you still need to let that 6 crore grow because you've got another 40 years minimum in terms of living expenses from 40 to 85, I would assume. But again, a very simple answer: 75%. Let it stay invested, and 25% keep in a mixture of bank FDs and conservative funds.
My problem with this plan is 6 months down the line, uh, my the market has gone up by 40%, or the market has gone down by 40%. Both of those are possible on a 6 months timeline from when we
Right.
started. What do I do then?
Right. So again, I think this situation is probably more pronounced when you are technically retired, because when you're younger, there's a lot more risk-taking capacity, and you sometimes tend to soothe yourself saying, it will recover, I'll do an extra SIP, or I will invest some more. Now, as a retired person with no, let's say, income coming in, yes, your corpus, any hit to the corpus actually is a bigger worry. Obviously, if it goes up 40%, I'm happier. But I would say, see, I have kept aside 2 crores, which is going to fund me for the next 2.5, or even 3 years of life. And hence, I shouldn't be worried with what my equity portfolio, which is a 75%, doing. And that's where I think there's a challenge for retirees or early retirees, is how do I switch off from watching my money control every morning to see where we're heading? You did it, and we will come to it, but you've managed to get to an 8 crore portfolio by actually doing certain things and believing in an equity product, believing in financial products. Why do you suddenly feel that once you've turned 45 that these same products will not work for you? Or so I think we need to find a balance. There is definitely a risk of watching a market panic, but we've been through COVID, for example. Some people would have been through the financial crisis in 2008 as well. Human nature, you have to bet on eventually the graph will slide up back. The question is 3 years enough? My view is yes. If you really feel, again, your entire portfolio is not going to get wiped out if you follow certain diversified investing rules.
Fair. So, if I understand it correctly, what you're saying is that even if such sort of fluctuations happen, let them happen. That's because you have enough debt to take care of your needs. So you shouldn't really change your fundamental strategy because the market has fallen by 40% or gone up by 40%.
Yes.
Fair. I'll give you.
So one thing I just add, Ravi, I think, again, if somebody, were to do this for themselves, just try and think what kind of an investor you really are. Because if, for example, at 45, if you are genuinely a very risk-averse person, you could consider parking, 3-4 years of money in a fixed deposit and taking care of it. 2, you could even buy some form of an annuity, which at least takes care of a bare minimum cash flow. So if I need 2 lakhs to run my house, which includes 1 holiday every 6 months, I might do an annuity for at least 75,000. So at least, the house is running. I'll then postpone my holiday to next year. So, it is the end of the day, retiree, whether it is 60 or 45, cannot really have everything assured. There's some risks that you take.
True.
So you could look at an annuity is basically what I wanted to add, saying at least some portion of cash flow then gets assured and you're not stuck with a very volatile stock market.
Correct. So see, there will be, cash flow generation is, it's a genuine problem that I am going through, because what happens is, when I planned my finances, I did my finances based upon the idea that, okay, whenever I need cash, what I will do is I will sell some of the assets that I have, some of the liquid funds that I have. And I do it, I keep the money in liquid funds for that reason. But the fact that I have to sell it instead of an income that is automatically coming in, it is a very different psychological issue. So if you buy an annuity, or even if you do something as simple as an SWP from one of these liquid sort of funds, it can take care of it. And I have been thinking of doing it for a very long time. Just let's have some money which is automatically coming in and
Correct.
flowing in. It's a great thing to have psychologically, that, suppose your expenses are around 1.5
Correct.
lakh rupees a month. I'm not saying you do it for 1.5 lakh, that would be inefficient, but you do it for 75,000.
Exactly.
So it's a brilliant
Then I think the
idea.
beauty of
Mm,
SWP, and good you
mm,
brought it up.
mm,
See, it's extremely flexible, right? You
mm,
might say, I assume in your case, the first 2 years of fire were really
mm,
okay. Let's not worry about
mm,
any income coming in. So
mm,
you might set a 1 lakh SWP. Now,
mm,
2 years into it, you may feel okay, but there is some base revenue coming in through what I like to do.
mm,
So you turn it down to 90,000, right? 3 years
mm.
later, you might take it back to 120. So unlike again,
So
and another point I think is eventually capital gains so far is
uh,
the most tax efficient way to get your money, because you're paying long-term capital gains rather than, being income tax at 30% slab or
please don't,
20% slab.
please don't give the government any more ideas
No,
of,
no, it's already
you
capital
know,
gains are there. So,
no,
I'm sure, the
I
finance
agree.
minister is not tracking us.
I agree. It's a very tax efficient
Yeah.
way, but
More than
frankly
the tax, I
speaking,
think what you raised is more relevant, that it is very
hmm,
flexible, and you can turn up and down your SWP basis, what you and your family need as cash flow every year in this new phase of retirement.
hey, so coming back to the capital thing. So 75-25, I am sold. Let's go ahead with that. How frequently do I need to rebalance it, in your opinion? Once a year, 6 months, or just let it be and see what happens?
No, so, I think the typical textbook would probably say once a year. I would
Hmm,
add to it, you look at it once a year, set yourself up a little wider guideline, which another 5,
hmm,
10% in between, and then see if you really have to rebalance, because in seeking, the textbook perfection, you'll just end
hmm,
up paying a lot more costs. Just to give you an example, right? I have seen sometimes where, oh, my equity portion has crossed 71%, my target is 70. So by the time you
hmm.
say, okay, let's sell, who knows, a week later the market itself corrects and you
Both
break it.
again.
So, I
So
think, not really from that it
maybe
can't be
I
done on your
get it.
own,
So
but it helps to
uh,
have something written down at the start saying what is this portfolio going to look like and what are the
hmm,
rules you're going to follow. Because it's very easy to get carried away when, especially in a market like right now, saying,
hmm,
yeah, I'll still make 40% on my equity and take more of it. Again, people with
I,
income, cash flows coming in have a different risk appetite. A
hmm.
lot of what we are talking today may not make sense from a maths perspective, because the psychological side of, hey, I'm not going to be making 4 lakhs a month,
I
5 lakhs a month, is a very tough one to, explain. It's something you have to feel.
true.
You probably will cover it on some other calls, but that, getting that 4 lakh salary a month to suddenly, there's no inflow coming in,
Hmm.
changes our bit of thinking.
True, man. True. I have been through that, and it takes a little bit of maybe 3-4 months adjusting to the new routine, so to
Correct.
say. To be really honest, I also felt very similar, around a decade or a little more than that ago, when uh, I quit my regular job and then I started my business. That point of time also, I had a very similar thing. Okay, salary is coming, and then it suddenly stops because you're doing your own thing, and
Correct.
in that own thing, eventually it makes money, and you have a very clear business plan and stuff like that. But that once the salary stops, it does hit and make a difference, so to say. About the balancing part, so once a year, and let's say 75 is your thing, then don't do it at 76. But maybe if 75 has fallen down to, let's say, 65, or if 75 has gone up to 90,
Yeah.
then yes, you take a call on rebalancing it.
Okay.
Fair. So now, I'm more or less have some sort of an idea what how to put this money. Then my next question is that, okay, because it's a significant chunk of money we are talking about, do I talk to someone else, some professional about it, or do I, let's say, do the simple index fund route and not bother with it? So basically, what I'm trying to ask is that should I take the do it yourself route, or should I take the going through a professional route? How do I do
Okay.
that? How do I figure
So I
that out?
know people who listen to it may say, listen, I'm just talking my own book and saying, oh, go use an advisor. But see, think of it like this. This is one of your biggest life projects, right? If you were building your dream house, even an architect who's, done it will tend to go to another architect and get some advice. Here, I'm planning two things, right? Also have to look at it as you may be very equipped to handle some of these decisions, but is the other member in the house equally able to do it if you are not to be there, or of an injury or something? So I don't see any harm in getting professional help. And today there are various forms. You could go to a one-time advisor and say, listen, this is everything. One time, tell me what I need to do. Or you could work with somebody on an ongoing basis. Or the third one is, again, find good friends in your network who will treat it with professional this thing, right? It's not just my friend saying, "I kaam kar le, ye fund le lo." But somebody who says, okay, Ravi, let's work for a month, let me tell you what it is, but we are friends, let's not worry about a commercial. That's the last route. Two, in terms of products, see, again, whether it's index funds, active funds, that's not really the big decision. The decision is now, where do I put this money? You can go on and on about index funds will eventually do better. Someone can throw data up which says even in the last 1 year, active large cap funds have beaten. So it's not really the product which you worry about. Find somebody who you can trust. Two, investment is one aspect of the entire thing. Does this person help you with the other financial needs that you will have at this stage? Whether it is even simple stuff like the documentation, will writing, succession planning around your assets. Will somebody else? And see, we are all, we are talking about, for example, right now we already reached 45. You probably have some property somewhere. You will have some rental income. Maybe you're thinking of, winding up some of your earlier investments. So there's a bit of work to be done. So there's no harm in reaching for help. Today, professional tennis players have a coach, cricketers. So, example I give everybody is, Virat Kohli still has a coach. Are we saying he doesn't know how to bat? Does he not know how to play in India versus play in Australia? No. But there is something that always somebody from the outside can point to us. DIY, if you are very certain that, listen, I am very comfortable with my decisions and I will get there and I don't worry about what my neighbor says. Right? And that is something you have to be true to yourself. Most advisors, and I use advisors as a catch-all word, it can be a mutual fund distributor like me, it can be an RIA, it can be maybe even some insurance folks, right? I know we'll all say the insurance folks are bad and don't go to it, but there are some good insurance agents who will help you with all of this. So take advice, ask them the very tough question, how much money are you making off me? Right? And if that is something where I'm going to pay you 5 lakhs, but I'm going to get 50 lakhs worth of value, in my view, that's a clear decision. Yes, please, where do we start? But if he's going to pay, you're paying 5 lakhs and get no value, you may ask, how do I judge value? No, that's like judging any relationship. You see what it is. And obviously, please do invest some time in educating yourself, but there's no need to do all of it your own, right? You want to retire to enjoy doing something else. not to go back to pick stocks and, watch the market for 8 hours a day and worry whether now is the time to buy or sell. So there's a lot of options to take help. Ask for referrals, ask family and friends who they work with. End of the day, an advisor you need to be comfortable with. Good advisors will create more value than the fee that they charge, even if the fee is a commission.
Fair. So this is something that I have very strongly felt, that any financial decision that you're taking, which is a big enough decision, even if you take it yourself, you need a sounding board.
Correct.
So, however confident you are of your abilities, and that's a good thing. Absolutely, you should be. And at the end of the day, it is your money. So, boss, the buck literally stops with you. But having a sounding board for any project is really, really helpful. And that's essentially the reason why I have been in touch with Kartik for a couple of years now, maybe a little more than that, I don't remember. And I have pinged him up for, asking about, okay, should I do this? I'm thinking about these funds, etc. And so all that is there. And so, Kartik, let's say if someone wants to, reach out to you for taking your services, what's the best way? I know the answer is not on Twitter, man. You need to be a lot more active on Twitter.
No, I know. There's only so much time. No, I think the best way is, so I post regularly on LinkedIn. I tend to write, more than 180 characters or whatever. I know it's gone up now. Or, visit the website fiscalfitness.in and just, have a look and see what I do with people, or just book a call. And, as I said, it's never about the fee. Unless you create value with people, it's not going to work. So, yeah, if you are thinking of fire, etc., do reach out and I'll see how best I can help you. But yeah, maybe this year you might see me a bit more on Twitter, but yeah, just
and you have to be, and I'm telling you, because what I've seen in terms of the crowd on LinkedIn versus Twitter is LinkedIn has a lot of very serious crowd, no doubt about it. People are very, very professional over there. They are there for the serious discussions, etc. But the sort of reach that you can get on Twitter for the same idea that you're putting it out there would be significantly higher, because there someone needs to invest. He is in a serious mood. Someone needs to invest time and effort into reading that more than 180 characters. But a lot of these ideas can be put out through tweet threads. So you don't need to write one long post.
Correct.
So come on, man. You at least this year, again, so it has been 2-3 years that I've been pushing you to do this. Boss, get on Twitter. So let's say a 25-year-old or a 30-year-old, let's pick up a 30-year-old or someone like that. In the beginning you talked about, let's say, there's a young guy who's worked for 8-10 years and he has realized that, it's not really for me. So a person like that, how does he get to, 45? How does he plan his journey that, okay, what do I do? I'm making whatever money I'm making. How do I put it to work so that I can get to, the fire stage?
Yeah. So I think, there's 2-3 parts to this. One, fundamentally, you first have to start saving and investing. See, if you're really passionate about a fire goal, it cannot happen just on luck or, some windfall at 42, you'll suddenly get an inheritance and then say, I'm fire. So for the person that we are talking about, late 20s, it's not really trying to save a big number. It's actually 20 years nearly of compounding that you're going to get. So again, we don't have to hit a 6 and try and target 25% returns, right? Even 12, 13% for 16, 17 years creates wonders. So couple of things you should really look at. One, believe that equity is the way to do it. So now be very clear at the start and, start saving and investing. You can do an index fund, you can do an active fund. I think a lot of people get stuck in that discussion debate trying to find a perfect answer. I say just start. Choose a fund which, even if you just say, "Hey, iska color acha lag raha hai," I'm buying. See, the worst performing equity fund is still given double-digit returns. So, don't try and find the perfect answer. It could be as silly as, I saw that hoarding this morning and I opened the app and I started saving. Two, be consistent with it. You can't just do one SIP installment and then expect, when you open that app to have 8 crores. Three, you also have to keep stepping up that saving that you're doing. I mean, most SIP calculators today talk about a static number and say, if you save 25,000 for the next 20 years, you'll get to a crore kind of math. But the reality is your first salary is X. By year 6, year 7, you're making some multiple of X. Your expenses need not go up in that same multiple. It will be a little low. I'm not again saying, if at the start of your career you cycle to office, you will cycle to office at 39 as well. Do buy a car. But see, end of the day, it is what is really your priority. Now, if I want to fire at 40, then I cannot be taking on 4 EMIs in my early 30s for frivolous expenses. So, and again, it comes back to the advisory capacity. Find somebody to do these numbers with you to at least tell you what is expected. You can then turn around and say, listen, this is too much. I can't save 30,000. I can save 5,000. But this magical step-up SIP will help you because, again, a lot of fire and personal finance actually is, you can use the word magical simply because of the time and compounding. And we can't, my brain at least can't do that maths of iske upar type. So if you ask simple interest, we'll all calculate. But, raise to the power is not possible. So get a simple Excel sheet. It need not be complicated. Very simple maths. What is it that you need to save? Where I think people make mistake is they feel they can only start this when everything is aligned, which means I have to be well settled in my job. I have to find the best fund. No, not again as a, you mentioned this word luck. See, I don't think it's only luck. It's also, sometimes not taking the decisions, getting swayed by movements around you. You can say I was just lucky to hold it, but see, it's very easy. The example I want to give you is, and I just tweeted about this. I started investing in my first job, HDFC FlexiCap. It's out there. In this June, I'll complete 23 years of holding that fund. Is that the best fund? I'm sure one of the viewers is going to message us saying, if Kartik, you instead of that fund, you had bought XYZ fund, you wouldn't be sitting on Y, you would be sitting on 1.8Y. Fair enough. But I'm saying I'm happy with Y. Two, if you in 1998 had sold it and then rebought it, see, these are all where people are getting distracted. What has worked honestly, now people will now again say you were lucky that you bought HDFC, right? You could have even bought something. But I had 23 years to take decision points, right? If I fundamentally had made a mistake and, somebody pointed out saying, hey, Kartik, you made a mistake. You should never have bought it in the year 7. I could have made a switch. See, none of these decisions that we take are like one time and non-correctable, right? You can always go back, take the right advice. For example, a lot of people today at 23 will go buy themselves one Jeevan Anand policy endowment, which says when you turn 50, you'll get 50 lakhs, without realizing that 25 years later, 50 lakhs is equal to today's few lakh. But that's a decision you have to correct right away. But just because, a fund you've chosen is not working. Two, again, today, I think a lot of people have ESOPs as part of their salary structure or the way they look to make wealth. Now, that could be some bit luck. Again, you're fortunate to work in that company, get a job there. You've done some numbers to make sense of why you should, not encash it in the middle of the journey. So investing is not 100% luck. Yes, definitely. I was lucky with some calls. You're lucky with a few of your breaks. But it's about saying, what is our process? What is the number we can control, which comes to the SIP number. You can control it. We can all put in 12, 19, 25% in my return column, but market is not obliged to give us that number. And hence I'm saying, maybe for the third time, run this with somebody, right? You don't have to say, listen, it only has to be all on my own. And most people will get the basics right. They just need a little bit of hand holding on the edges, which could make a big difference between fire at 48 and fire at, say, 55, right? And that's what you're trying to achieve.
What I've realized, and things become a lot simpler if there is some sort of a path which is suggested that, do this, do this, do this. And either you write that path or write that story yourself. If you can do that, brilliant. But if you cannot do that, that is where having someone else to tell you what that path should be becomes really, really helpful. That is essentially why talking to a professional, especially if you are in that 25 sort of a zone or 30 or 25, 30 sort of a zone, I do believe it makes a lot of difference for that age bracket of 25, 30. Just talk to someone and see. And the other thing that I've seen is that a lot of these folks believe that, no, I don't have enough money to, invest and get a professional to help me with it or something like that. I don't think so, because there are a whole bunch of advisors who will be available to you, and the money that you will end up paying to them is going to be insignificant in comparison to even a year or 2 years thing. So it does not make that much of a difference until and unless you get scammed, which is where the problems and challenges I have seen happen, because shit like
on
that.
This, I'd say there are two things, right? See, one, you are also opening yourself to get scammed when you are only chasing like a return, right? See, if you're chasing greed, it becomes easy for a person to sell to you. And, again, I'm not a fan of ULIP in that sense. But again, if you look at it structurally, the product, if it's held for 15 years, 17 years type of duration, equity, the underlying, and if it's an equity fund, can give you a good outcome. It's the mismatch where people think they're going to be invested and then take it out next year only to be told there's a 60%, 70% penalty. So what you're saying is perfect. See, find somebody for the thing. In terms of scamsters, then that's going to be there everywhere. But hence you go through either referrals, you go through, see if they're even qualified. It's again, not everybody, just because they have 3 letters after their name makes them better or worse. But ask them, talk to them. It's like choosing a partner with whom you want to work for not just 1 year, right? This is going to be an ongoing affair. Good mutual fund advisor today will say, like, even if your SIP is 10,000, 20,000, I can take you on board in a way. Not everybody is only aiming for the ultra HNI who says, here is 50 crores, please invest. And, you have to find, again, what is working for you. If you need just once in a while sounding board and you know what to choose, maybe you want to do a more digital first approach. But if you want, somebody to talk to me, please explain what are my options, right? My granddad said buy LIC. My father is saying, do FDs. You are telling me do mutual fund. All 3 actually answers are valid. Now it depends on how do you mix and match it. And as you said, find somebody. This is not a project to, put out and say, hey, I did it all on my own, because there could be a big gap if you get it wrong, especially because it's wrong over 20 years. And if you, don't, and see, I think most advisors will tell you what is right or show you. Eventually, if you choose to still do what you want to do, any professional is going to walk away. Like it's a doctor. I look at it as, most of these are financial doctors. I go to a cardiologist, if he gives me some advice. After the 3rd meeting, if you have not cut out what he's saying, you have to give up, right? You can't say, no, I insist you follow a diet or you stop smoking. My point is, ask for help, go through one or two people who've already taken that help. They will tell you what value an advisor brings into the equation, a mutual fund distributor brings into your life. So which is what I'm saying, you have to, one, either give up, your active job career and say, let me become a personal finance professional, or let me find a professional who's going to help me, right? Because again, I think the upside definitely is in doing your own job. There's far more application of your skill set to make that 10x. Then saying I need to worry about, which stock to buy, which mutual fund to buy, which, Gropital to buy or to avoid, right? There is, see, at the end of the day, my sense is people have thought just because it has become simplified in terms of a user experience, the core concepts haven't become any easier, right? I mean, you recently, tweeted to me about that. So you messaged me on that Morgan Housel book, Same as Ever, right? The book itself is same as ever, right? He says nothing is changing. But what we are seeing today is exactly playing out, right? Tomorrow, a Gropital is going to be replaced by somebody else who comes and says, we saw it in the middle of crypto. Somebody took an extremely volatile asset called crypto and said, I can give you FD-like returns. Like, how can I take something which moves up 20-30% every second and give you a short 12%? We've seen various, I think the key is, there is somebody who's going to look at this, we will get it wrong. Good personal finance professionals will be late to most parties. So, but it is with an objective that at least my capital gets protected. It's okay if I give up some upside. You're seeing, a trend, for example. Now, I don't know how they were going to play out over the next 5 years, but whether it is P2P lending, whether it is the entire alternative space in terms of, hey, listen, invest. See, an HNI can afford to put 2 crores into some, factory on the outskirts of Jaipur and say, let me get some return, whether it comes this year or next year, doesn't change their life because they have enough money. But if you put your entire life saving of your parents into and saying, Mummy, you'll get 18% return from this factory, she may go for 2 years with no money coming in and you find, the Jaipur authority come and say this land is illegal. So everything cannot be equated to do it like the rich boys or girls because we've got an app to break it up. Having said it, see, obviously there are good innovation that's happening. Doesn't mean we all have to do traditional, only form of investing. But have somebody in between who puts a balanced view out there and you make a more informed decision rather than going with a presentation which only talks about the return side to this discussion.
Fair. So, when people come to you, so one is these obvious blunders where you're putting in an asset where, you lose your entire capital. What is some of the common stuff that you are noticing, that, okay, a bunch of people seem to be doing this and it's not really a great idea. Do you see some patterns?
The 30 to 35 age group, right? They have been, buoyed by this whole stock market and are trending towards, I can build my own portfolio. I know what stocks to buy. I open my trading app and they've got good returns, comparatively. There's a big gap in terms of actual data that they have because, again, a lot of portfolio apps don't do XIRR for the portfolio and stuff. So we have this thing, Kartik, I bought middle of COVID.
Does that now?
No, not for the entire portfolio. See, single stock, it's like when you talk, eventually you're talking about a portfolio return, right? See, I can have, I will give you an example. I don't do direct stocks, you know that, right? I don't advise on direct stocks, etc. But, on the side, once in a while, you dabble in something. Right. But I think people will come with, what, in the middle of COVID, I was very clear that after lockdown, revenge tourism will happen. The name got coined only very recently, but This gentleman knew about revenge tourism in the middle of COVID itself. So I bought Indian hotels, I bought Lemon Tree, I bought whatever. And they're all up 3x, 4x. But what they don't calculate or look at is you bought like 100 shares. Your net worth is like some 25, 30 lakhs, 100 shares, by what? But you will, tell people that I'm very good with my stocks. I identified 3 multi-baggers in my lifetime. Versus, seeing, but what is your overall portfolio? Where are you allocating? The same person has also lost some money in buying Ape, whatever that was called, right? The NFT craze. So, see, you have to, at the end of the day, look at your net worth and how that is trending. No point saying, hey, one good hit I got, which was one direct stock of mine. But if your rest of your money is sitting in an FD, right, you miss the major part of the bull market in that sense. The 40 plus category, I think I've now learned some of these mistakes. So they actually want to simplify everything, and they come, when I wrote a LinkedIn post recently, 60 schemes. Everything looked good, right? We bought this, new AMC came in. That AMC told me buy a multi-asset fund, which is based on XYZ framework. The other guy offered another framework. So I bought. Eventually, you're holding so much and you're holding the market. So again, you lose out in that. So this is a clear trend I see. The younger-ish audience wants to do everything on your own, but they don't get some of the core, see, if you really bet it, make a sizable bet on it, right? Even if it is, or they just throw risk out of the framework. Very common example you'll see of people working in some form of a startup, investing in that same startup, and, being dependent through their investments in the similar space. So, again, the media and generally success stories are shown when it is a concentrated. Everyone will say, but you remember Jeff Bezos only bought Amazon stock. Or you remember Bill Gates only had Microsoft in his portfolio, he didn't have. But those are one-off, right? There are so many other people. And two, you can slowly start concentrating your portfolio once, it becomes successful, you covered your bases, you have enough free money. So, we know for a fact, tomorrow, even if Microsoft falls 20%, you're not going to see Bichara Bill Gates standing in the corner saying, sir, my stock has fallen, please help. But these are people who link their life's EMIs, cash flow on a single stock idea. So that's one big risk you see. And then we'll say, obviously, the stock market's a scam, it doesn't work, people lose money. And they over-diversified because they want to try everything. So you have to find a way to say no to products, even though it means, there are good products out there, no doubt, today. But think of it as, you have a cricket team, you're a selector, you can only put 11 players on that field. The same way, my mutual fund portfolio has only 6 funds. Some of them obviously are very old because they were only in existence 15, 16 years back. But I happily give up saying, okay, I don't hold a quant mutual fund today in my portfolio. Phenomenal returns backed on a very different style of investing. But that's life, right? I mean, I can't now hold some this and that.
Again, if it was so simple to know what is going to, perform in the next 2 years, everyone would just buy that and no one would buy something else. So that is fairly, obvious. But true, I don't know, man. So I don't think I've ever been guilty of putting, or even thinking that I can beat a mutual fund. I don't think that I can beat the index, or I don't think that I can beat a mutual fund manager who manages, thousands of crores, who has done this entire life. And a hobbyist will go and beat him.
We obviously have advantage as a hobbyist, saying that, your holding period could be longer, you're not swayed by the news. But again, I think if you look at coming back to FIRE, I think the biggest driver of that is going to be your income source. You don't expect the return on my product to replace the basic food to this engine, which is income. You can't FIRE with a 5 rupee income, right? I mean, if your salary is going to remain 20,000 for the next 20 years, see, then you can't fire. Don't come and say, "Hey boss, double karke do, triple karke do stock market se." But if you can consistently focus on your core job, keep skilling and growing it, then I think, the fire becomes easier, because eventually, those skills can also supplement your income. You might not have to work 9 to 5, typical sense. So my clear is focus on your job. Unless you're a fund manager who's listening to this conversation, don't get into all the stock picking, etc. Leave it to even do an index fund. Again, there will be index, active, passive, smart beta, all of it. Choose one which you think is aligning with your process and stick with it. If not on your own, definitely run it at least once a year with somebody saying, listen, this is what it looks like. Please give me a health checkup and tell me where am I going wrong. That should be, something like you do a body health checkup. Just get your financial health checked up once a year, and, make those edits as you go along, because it's never going to be a perfect time where everything comes together and says everything is right. There will always be some 80% correct answer.
True. Chalo, करते हैं यार. मतलब this is important कि people really need to understand this, and people have asked me, so I'm very who is not really into this business. I'm sure that there must be multiple people who will come to you and ask you कि hey हटा सब छोड़ो, मेरे को बताओ, मतलब फंड का नाम बता दो जहाँ पे मैं पैसा डाल दूं, and that takes care of everything. It doesn't work that way, that okay, you tell me the fund कौन सा चाहिए which gives me best returns.
So that's the challenge. They search for the best. Even if you give them a fund, that same person will call you 3 weeks later saying, मैंने तो डाला है, but I saw something else which has in this last 3 days given little more than what you said. On a long-term horizon, if you see, the key is, can you be staying invested through these cycles? And anyone who says there is no more, I can predict, you'll be one-time lucky, right? And, for if you take international examples, that Michael Burry guy who called that the short,
the big short.
Yeah, he's been saying there's a crash in the US for the last 1.5 to 2 years. And in fact, he's tweeted, I've sold everything of mine except one prison company, I think he said. But he's been wrong fundamentally. But yeah, he's minted his money in his first short. So I'm saying eventually the prediction game will all predict one time correct. If I can market my prediction and live off that 1970 wala glory, is something else, right? But or you just say, listen, fundamentally India will do well, equity will do well. I need to be in some form of equity. And the best way, according to me, buy a bunch of mutual funds. You don't know what to decide. Trust your advisor who's going to cut it and dice it up, because my sense is only going to get worse. You already have 45 AMCs, another 5 AMCs coming, each one with another 20, 30 offerings.
Okay, so this is again a big question that I have. So a new AMC is coming, it has to establish its business, it needs to start its funds. Why are the older existing AMCs keep launching it, man? I have seen.
No, Ravi, see, that's a simple question, right? You look at it as a product manufacturer. You take Kit Kat chocolate, right? Why do I want Kit Kat with 80% dark chocolate? Because I know these two gentlemen like eating dark chocolate at night. Now, why do I launch Kit Kat with milk flavor? Because ये बच्चे लोग को ऐसा milk वाला पसंद है. Now I'll add some guava flavor mirchi. Like, I mean, you take Japan as an example, I don't know, they have hundreds of Kit Kat. See, product manufacturer has to keep manufacturing because that product makes perfect sense for somebody in that universe. See, today, for example, with you, right? If I were to design a mutual fund product which would give you this kind of profile, इसमें थोड़ा large cap भी आएगा, no mid and small cap, and let's say a certain component of debt. You might be like, it solves my need because it is just going to deliver a 6% with equity taxation. मेरे लिए ठीक है. I only want 6% rather than putting bank FD. So it makes sense. But now for a 28-year-old, he'll be like, why should he buy it? And go buy a diversified equity fund. Now again, some audience wakes up and says, no, I don't want to trust the mutual funds with the large cap money. let them only do the mid cap for me because I know how to buy between a TCS and an Infosys or the reverse. See, always think of it as they are manufacturers. They will need to offer a range. At any point of time, one of their products will be in demand, which they will talk more about. But as a manufacturer, it's like car companies need to have diesel, petrol, 4 more variants in it because of a price point. Somebody wants a 13 lakhs mein ye gaadi chahiye, somebody is ready to pay 18 lakhs for the same brand. So we need 4 options. So I don't think it's the problem. I think the problem is we'll have more such products coming in. You need 5 or 6 funds. Avoid having everything at one AMC simply because that's too much of a risk to take. And maybe, once in 4 years, 5 years, some genuine new category product comes in, which you say I might need because of my situation. Otherwise, think of it always a manufacturer will launch variants. It is suitable for somebody in the audience, not necessarily you at all times.
Yeah, sometimes do get, these calls, कि अरे सर ये नया फंड लॉन्च हो रहा है इसमें ले लो and all that. I get those calls. तो मैं politely नहीं बॉस करके हम मना कर देता हूँ. But I don't know, man. There should be. I think SEBI would probably put in some sort of restriction on it someday that kitna. And to be really honest, they actually did this a little while ago when it was.
So they've done the categorization. But they've left the sector. They've left the sector and thematic because, see, again, you need now. There are new themes coming in, and again, I think you can't really tie your hands too much because there will be some innovation happening in this space. Somebody will think of how can I do A plus B, which hasn't been done so far. So it's good. It's good to have choice. I think it's easier to exercise caution and not fall for every product.
So just one final thing. So I remember reading. I think they are launching in the US crypto index funds or some stuff like that. So that is the I don't know if it happens, doesn't happen, good idea, bad idea. I have no idea about that. But that would be a fundamentally different innovation which comes in if it ever comes in. So that's essentially the idea that way too many funds, and another reason for probably having some sort of a professional to tell you, okay, boss, which one to pick and which one not to pick. I think let's wrap it up here.
Sure.
So thank you, Kartik. Thanks a lot for taking out time today and for the chat. And from the viewers, I request you to please like the video, comment on the video, subscribe to the channel. And from Kartik, I would request you to please become a lot more active on Twitter.
Definitely. Thank you so much for having me. For the simple, enjoyable conversation on fire. I think a lot more people can do this. Right? It's not difficult to achieve fire with the right.
We sure hope so. Thank you, Kartik. Thanks.
Great.